Welcome to Money and Banking. On microeconomics, we have learned the apple market, the pizza market, the labor market, the energy bar market, the individual markets. And in macroeconomics, we have learned money market and aggregate market for the whole economy. In money and banking, we are analyzing another market called financial market. And we are going to spend the whole class to talk about a market, that is the financial market, a very special market. So the goods in the financial market is fund. The function of the financial market is to transfer funds from the fund suppliers who have money but do not have an investment opportunity. Transfer those funds from the fund suppliers to the fund demanders. And the fund demanders are who do not have money but they have the investment opportunity. If we can transfer funds from people who have money but without investment opportunity to people who do not have money but have investment opportunity, then the capital, the funds, the money can be allocated efficiently in production, in producing the real goods and services. Let me give you a simple example. Say, for example, my dad used to put his money underneath his bed. Then what is the return of his money? The answer is 0%, because the money will not grow by itself. However, if my dad can lend his money to an entrepreneur, say for example, and this entrepreneur sees a 6% return opportunity, and he agrees to give 3% to my dad. Then my dad will lend his money to the entrepreneur. What is the total return of my dad? The answer is he will earn 3% from the entrepreneur. What is the return of the entrepreneur? The answer is he will use the money to earn 6% and pay my dad 3%, so he will earn 3%. The result, the whole economy earns 6%, compared to the case that my dad put his money underneath the bed and the entrepreneur does not have the money and waste the 6% investment opportunity. In this simple example, you can see how important a financial market is. The importance of the financial market can be seen very clearly in the recent financial crisis. You may not remember this, but on Friday, September 18th in 2008, the peak of the financial crisis, it's a Friday. Then Treasury Secretary Henry Paulson and then Fed Chairman Ben Bernanke asked the legislators to bail out the big banks. And Ben Bernanke said something very important. He told the legislators that if we don't do this, if we don't bail out the banks, we may not have an economy on Monday. When the market opens on Monday, our economy will crash. This is how important a financial market is. Without this machine to transfer funds from the fund suppliers to the fund demanders, the economy will not run. There are two ways to transfer funds from the fund suppliers to the fund demanders. One is called the direct finance. The other one is called indirect finance. Direct finance is to transfer funds directly from the lenders, the savers, to the borrowers, the spenders. The indirect finance is to go through a financial intermediary to transfer funds from the lenders, savers, to the borrowers, spenders. So it's very clear. If the borrowers borrow money directly from the lenders, then it is called the direct finance. If they go through a financial intermediary like banks, then it's an indirect finance. Say, for example, if you save your money in the bank and the firms borrow money from the bank, this is an indirect finance. If McDonald's put their cash into the bank overnight and firms or government borrow money from the banks, then it is an indirect finance. If the government collect taxes on April 15th, they are not going to spend all of them. So they save the money, they put the money in the bank, and then you borrow money, you borrow mortgage from the bank, then this is an indirect finance. If foreigners buy, say for example, our bonds, and then money to the bank, or buy bonds from an investment company, and then a foreigner in our country borrow money from the investment banks, or a firm borrow money from this investment bank, then this is again called an indirect finance. Throughout the class, we are going to emphasize how important the financial intermediaries are. That is, most of the transactions are going through the indirect finance. Why? We are going to spend Chapter 2 and Chapter 8 to talk about the answer. So what kind of financial intermediaries that we have? Well, we can put the financial intermediaries into three groups. The first one is called depository institutions. So what are the depository institutions? A financial institution where you put your money in, deposit your money in, and then you can write a check to withdraw your money. Then that institution is called depository institutions. So you deposit money and then write a check to withdraw the money. Then that institution is called the depository institution. Say for example, your banks, your credit unions, okay, you can write a check to withdraw the money. Then that institution is called depository institution. The second one is called contractual savings institution. So what kind of institutions they are? It's contractual. So whenever you put the money into the institution and you have to sign a contract, that institution is called contractual savings institution. Say for example, you buy a life insurance. Do you have to sign a contract? Yes. You sign a contract, you pay the premium, and the life insurance company use your premium and then lend money to the firms. Home insurance, your car insurance, do you have to sign a contract? Yes, you do have to sign a contract, and then you pay monthly premium or 6 months premium or yearly premium. Then they use the premium and lend the money to the firms or the governments. So they are a contractual savings institution. They are the second type of the financial intermediaries. Pension funds, your retirement 401k, Do you have to sign a contract? Yes. Therefore, they are the contractual savings institution. Finally, the rest is called the investment intermediaries. Investment intermediaries. Those include the mutual fund company and the hedge fund and finance company. Next, we want to talk about the classifications of financial markets. There are many ways to classify the financial market. We can divide the financial market into two parts or divide it like this, different classifications of financial market. The first one that we want to talk about is the classification of financial market. How can a firm obtain funds in the financial markets? There are two ways that the firms can borrow money from the financial market. The first one is they go to the debt market to issue bonds. The second one is they can go to the equity market to issue stocks. If they go to the debt market to issue bonds, depending on the maturity of the bonds, they can issue short-term bonds. That is, the maturity of the bond is less than 1 year. Say, for example, our U.S. Treasury issue Treasury bills. If the bonds is between, the maturity is between 1 and 10 years, then it is called intermediate term bonds. Say, for example, our Treasury issues 2-year Treasury notes, 3-year Treasury notes, 5-year Treasury notes, and 7-year Treasury notes. If the maturity of the bond is greater than 10 years, then they are called long-term bonds. Say, for example, U.S. Treasury issues 10-year Treasury notes. Be very careful. 10-year Treasury is a note. And 30-year Treasury bonds. That is, U.S. Treasury issue bonds to the market. Their short-term bond is called Treasury bill. Their intermediate term bond is called Treasury notes. But be very careful. 10-year Treasury notes, not 10-year Treasury bonds. Anything bigger than 10 years, like 15 years, 20 years, 30 years, they are called Treasury bonds. A firm can also go to the stock market to issue stocks. Okay? First question. What are the terms? What is the term of the stock? Is there a maturity of stocks? The answer is no. When the company issues stocks, they are not going to say, okay, our company is going to exist for 1 year, therefore our stock is only for 1 year. No, they never do that. Okay? So stocks, in theory, has infinite maturity. There is no maturity date for stocks because when the company is established, they want to be there forever. They cannot say we are only going to exist for 1 year. Therefore, say for example, GE wants to raise money in the financial market. What can they do? First, they go to the bond market, the debt market, to issue GE bonds to raise money from the debt market. Or they can go to the equity market, stock market, they issue stocks to raise money from the market. So what's the difference? What's the difference between issuing a stock and issuing a bond? The answer is, if you buy a GE stock, you become one of the owners of the company. So if GE sells a stock to you, they give you the ownership rights. You are one of the owners. if GE issues a bond, it's an IOU. If you buy a GE bond, then GE owes you money. You don't own the company. Therefore, there's no ownership for the GE bond holders. The second difference is, remember, a bond is a contract. When you buy a GE bond, you know what your future cash inflows are. Say, for example, when you buy a GE bond, they agree to pay you $100 per month for the next 36 months. So your payment from GE is fixed. That's when you buy a GE bond. Therefore, when GE is doing very well, earns a lot of money, how much are you going to get from GE every month? The answer is $100. If GE is doing very badly recently, they don't earn any money, how much money are you going to get from GE when you buy GE bonds? The answer is $100 per month, because it's a contract. They promised to pay you $100 per month for the next 36 months. However, if you instead buy a GE stocks, because you are one of the owners of GE, when the company is doing very well, they earn a lot of money, you are going to get more dividends. But if the company is doing not so good, doesn't earn any much money, then you may get zero dividends. Therefore, if you buy a GE stocks, your cash inflows from GE depends on their profitability, depends on whether they earn money. But if you buy a GE bond, you don't have to pay attention to them whether they earn a lot of money this quarter or doesn't earn money this quarter, because your cash inflow is going to be fixed if you buy GE bonds. The third difference is, if GE goes bankrupt, okay, that's the only time that you are not going to get $100 per month from GE, because they go bankrupt. Okay? If they go bankrupt, they have to pay their debt holders, that is, the bond holders. If you are the bond holders, you can claim whatever they have left. And after they pay all its debt holders, then if anything is left, then they can pay their equity holders, because the equity holders are the owners of the company. The owners of the company have to pay the debt holders first before they can pay themselves. The first classification we introduce is to separate the financial market into debt market and equity market. Another classifications of financial market is same market, financial market. We separate them into, we group them into money market and capital market. Be very careful. Money market, when you have these two words together like this in macroeconomics or in money and banking in the financial world, it has a special definition. This is not market for money. Okay, this is not the market for money. Demand for money, supply for money, demand for money, supply of money. No, this is not the market for money. Money market has a special meaning. That is, money market is the market where only short-term debt instruments, short-term securities are traded. The market where the long-term or intermediate-term securities are traded is called capital market. Therefore, first question, are treasury bills traded in the money market or capital market? The answer is treasury bill is a short-term debt, maturity less than 1 year. Therefore, treasury bill is traded in the money market. How about treasury notes? Are treasury notes traded in the money market or capital market? The answer is treasury notes, treasury bonds are intermediate term debt and long-term debt. Therefore, treasury notes and treasury bonds are traded in the capital market. Okay. Are stock markets money markets or capital markets? Remember, what is the maturity of a stock? The answer is infinite. If is infinite greater than 1? Yes. Therefore, stocks are traded in capital markets. Therefore, NASDAQ is a capital market. New York Stock Exchange is a capital market. Okay? Now, you probably have learned something called money market mutual funds. Now you know what money market mutual fund is. Money market mutual funds are the mutual funds that only buy and sell short-term securities. That is why they are called money market mutual fund. This is the second classification of financial markets that we introduce. The third way to classify the financial markets is to put them into two types of market. The first one is called primary market. The second one is called the secondary market. Primary market is, say for example, in the stock market, primary market is the IPO market. Initial public offering. Okay? That is what new securities is issued and sold to initial buyers. So this is actually where the borrowers get money. So the borrowers only get money from the primary market when they issue bonds or stocks. And then after those IPOs and initially issued bonds are purchased by individual or by the market, then those bonds and stocks will be circulated in the secondary market. Say for example, NYSE, AMEX, NASDAQ, they are all secondary markets. Remember the open market operation by the Fed? Open market operation, what market? U.S. Treasury bonds market. By law, the Federal Reserve banks cannot lend money directly to the U.S. government. Therefore, the Fed cannot buy U.S. Treasury bonds when they are firstly issued, they can only buy US Treasury bonds in the secondary market. So what's the difference? What are the differences between the primary market and the secondary market? Let's go into the details. First, okay, the corporations only acquire funds in the primary market. Remember, the function of the financial market is to transfer funds from the lenders to the borrowers. And the borrowers can only get money from the lenders in the primary market. So it seems to us that primary market is much more important than the secondary market, because the borrowers do not get money from the lenders in the secondary market. However, on the financial news, what do you hear? All you hear is the stock market, the NASDAQ market. On the headline, it's always the stock market, the NASDAQ market. In the monetary policy articles, it's always the open market, the treasury market. All the focuses are on the secondary market. That is, secondary market is actually much more important than the primary market. Why? Borrowers can only get money from the lenders in the primary market. Why the primary market is not that important, and secondary market is much more important than the primary market? The answer is, say for example, if I, James, issue a bond called James Bond, are you going to buy it? Well, you might buy it because you are in my class. But next semester, you are not going to be in my class. So you don't want to hold the James Bond and you want to sell it. Are there people who are willing to buy James Bond? The answer is no. So if you buy James Bonds today, you will have a hard time to sell it in the future. But are you willing to buy treasury bonds? The answer is yes. Why? Because treasury bonds market is huge. Basically, you can buy and sell any amount of treasury bonds in the market. Therefore, the secondary market, if you have a huge secondary market, say for example the US Treasury bonds market, then that will increase the liquidity of the security. Therefore, people are more willing to buy the bonds in the primary market. So the liquidity of the secondary market increases the liquidity of the primary market, increases people's willingness to lend money to the company in the primary market. Another thing is, say for example, in the stock market today, say for example, the price of Microsoft is $100. Now, Microsoft wants to issue new stocks. If they price the new stocks at $80, are you going to buy it? So this is the price in the secondary market, in the stock market. And this is the price in the primary market. When the Microsoft wants to issue new stocks and price at 80, are you going to buy it? Yes, because it's cheaper. You buy it and then hold it for a certain period, sell it in the secondary market. However, if the price in the stock market of Microsoft dropped to $80, and Microsoft wants to raise more funds and then issue more stocks in the primary market, and they price it at $80, are you going to lend them $80? The answer is no, because you can just buy the stocks in the secondary market. You don't have to buy it in the primary market and have some restrictions. So Microsoft may have to lower their price to $60 so that you are willing to lend them $60. As you can see from here, the price of the secondary market actually determines the price in the primary market, where the firms get their money, where the borrowers get their money. That is why the secondary is much more important than the primary market. Firms can not only issue bonds or borrow money, issue stocks, borrow money from the domestic markets. They can also borrow money in the foreign countries. Say, for example, GE can issue GE bonds in Japan. They can also issue GE stocks in Japanese stock market. If they issue GE bonds in Japan, say for example, there are two types of bonds that they can issue. The first one is called foreign bonds. The second one is called Euro bonds. Now this is a little bit complicated, but how to remember the differences between a foreign bond and an Euro bond? Let's use history. Let's review some history. Okay? During the Cold War period, the former Soviet Union, their firms are doing business, trade with the United States. So they earn some US dollars. But they didn't want to put the US dollars in the United States because they were afraid that US government would freeze their assets in the United States because it's during the Cold War period. But the business of the former Soviet Union needs to keep dollars to keep trading with the US company. Therefore, what do? They don't want to put the dollars, US dollars, in the United States. Therefore, they put those US dollars in euro. So the US dollar, this is US dollar bill, US dollar outside the United States is called euro dollar. But later, euro dollar becomes a more common term. That is, not only in euro. Any US dollar that is outside the United States is called euro dollar. Say for example, if you travel to Japan and bring your $10 bill, US $10 bill, that bill in Japan is called euro dollar. Does that make sense? Okay. If this is Japan, if a Japanese student comes to the United States and bring his Japanese yen, this yen bill is outside Japan. Therefore, this bill is called euro yen. if a Mexican student bring Mexican peso to the United States, and this peso is outside Mexico, then this peso is called Euro peso. Therefore, if a Frenchman take euro to Japan, then what is that euro bill called? The answer is it's a euro bill outside Europe. Therefore, it is euro. So in short, this piece of paper denominated in dollars, and it is outside the United States, it is called euro dollar. Same thing, if GE issue a bond in Japan, this bond is denominated in US dollar and is issued in Japan outside the United States, then this bond is called euro bond. If GE issue a bond outside the United States and the bond is denominated in the local currency, say yen in Japan, then this bond is called foreign bond. See the difference? Therefore, how to remember the difference between these two? Go through the Cold War history. Then it is very clear. A currency or a bond that is denominated in the issuer's currency but is outside the issuer's country, then it is called euro bond or euro dollar. So if the company issue a bond in a foreign country and the bond is denominated in the foreign currency, it is called foreign bonds. So if GE issue a foreign bonds, they will have to pay the foreigners in yen. If GE issue a euro bonds in Japan, then they pay Japanese the bond payment in dollars. That's the difference between foreign bonds and euro bonds. To make sure you understand this, let me ask you a question. If an Argentinian company wants to raise money in the United States, if they want to be able to raise more money, should they issue foreign bonds or euro bonds in the United States? Remember, if they issue euro bonds in the United States, that bond is denominated in their currency, that is peso. If they issue foreign bonds in the United States, then that bond is denominated in US dollars. If you are a bond buyer and you want to buy Argentinian bonds in the United States, do you want the Argentinian company to pay you dollars or pesos? The answer is you want dollars, because dollars are very stable. Pesos fluctuate too much. You don't want the uncertainty. You want the payments, the bond payments, to be dollars. Therefore, you want to buy foreign bonds. Therefore, for the Argentinian company to be able to raise money in the United States, they better issue foreign bonds. That is, the bond is denominated in dollars.